In the world of money, a good credit score is like a magic key that opens doors and gives you better deals. For rich business owners, keeping a good credit score is very important because it can help them get good investments, loans with low interest, and more freedom to manage their money. Here are 20 good ways that wealthy business owners can use to build and keep a very good credit score, so they can feel confident and at ease when dealing with money. Early by applying for a student credit card or establishing a credit builder account. Establishing a personal credit history early is like starting to save for retirement. Early, the sooner you start, the better off you'll be in the long run. Your credit history is like a report card for your finances, and it shows lenders how responsible you are with your money. The better your credit history, the more likely you are to be approved for loans, credit cards, and other forms of credit with favorable terms. Here are 2 ways to start building your credit history early. Apply for a student credit card. Many student credit cards are designed for people with limited or no credit history. They typically have lower credit limits than traditional credit cards, which can help you keep your credit utilization ratio low. Establish a credit builder account. A credit builder account is a type of savings account that reports to the credit bureaus. You make regular payments into the account, and the lender reports those payments to the credit bureaus as if you were making loan payments. This can help you build a positive credit history without actually taking out a loan. Number 2, maintain a low credit utilization ratio. Keep your credit utilization ratio, which is the percentage of your available credit that you're using, below 30%. Aim for a utilization ratio of 10% or lower for the best results. Imagine you have a credit card with a $1,000 limit. If you have a balance of $300 on that card, your credit utilization ratio would be 30%. This means that you are using 30% of your available credit. Credit bureaus like to see that you are not using too much of your available credit. This is because they believe that people who use a lot of their credit are more likely to have trouble repaying their debts. Aim to keep your credit utilization ratio below 30% and ideally below 10%. The lower your credit utilization ratio, the better your credit score will be. Here are some tips for maintaining a low credit utilization ratio. Pay off your credit card balances in full each month. This is the best way to keep your credit utilization ratio low. Make multiple payments on your credit card each month. This will help to reduce your balance and lower your credit utilization ratio. Request a credit limit increase. If you have a good credit history, you may be able to request a credit limit increase from your credit card company. This will give you more available credit, which can help to lower your credit utilization ratio. Number 3, make timely payments. Pay your credit card bills and other debts on time, every time. Late payments can significantly damage your credit score. Imagine your credit score as a report card for your financial behavior. Just like a report card shows your grades in school, your credit score shows lenders how well you manage your debts. When you make timely payments, it's like getting good grades on your financial report card. Lenders see that you're responsible with your money, and they're more likely to lend you money at lower interest rates. This means you'll pay less over time when you borrow money for things like a car or a house. On the other hand, if you miss payments or make them late, it's like getting bad grades on your financial report card. Lenders see that you're not managing your debts well, and they're less likely to lend you money. If they do lend you money, they'll charge you higher interest rates to protect themselves from the risk that you won't pay them back. So, making timely payments is one of the most important things you can do to improve your credit score and get the best possible deals on loans. Here are some tips for making timely payments. Set up automatic payments. This will help you avoid late payments by automatically withdrawing the money from your checking account each month. Pay your bills more than once a month. This will help you keep your credit utilization ratio low, which is another important factor in your credit score. Create a budget and track your spending. This will help you stay on top of your bills and avoid overspending. Making timely payments is essential for financial success. Number 4, monitor your credit report regularly. Just like you would check your school report card to identify areas for improvement, it's crucial to regularly review your credit report to ensure it's accurate and reflects your responsible financial behavior. Think of it like giving your credit report a regular checkup. By checking your report from all 3 major credit bureaus, Experian, Equifax, and TransUnion, you can identify any errors or discrepancies that could be negatively impacting your credit score. This could include inaccurate information about your accounts, payments, or even identity theft attempts. Regularly monitoring your credit report allows you to take quick action if you spot any mistakes. You can file disputes with the respective credit bureaus to correct any errors, protecting your credit score from potential damage. Number 5. Dispute inaccuracies promptly. If you find any inaccuracies on your credit report, file a dispute with the respective credit bureau immediately. Sometimes, mistakes can happen. For instance, a creditor might report an incorrect payment amount or date, or a closed account might still be showing up as open. These mistakes can negatively impact your credit score. That's why it's crucial to check your credit report regularly. You can get a free copy of your credit report from each of the 3 major credit bureaus, Experian, Equifax, and TransUnion, once a year. If you find any errors, don't hesitate to file a dispute with the respective credit bureau. This means you're letting them know that there's something wrong and asking them to investigate. The credit bureau will then contact the creditor who reported the information. They'll ask the creditor to verify the information and provide documentation. If the creditor can't verify the information, this can significantly improve your credit score. Number 6. Limit the number of hard inquiries. Hard inquiries, which occur when you apply for new credit, can temporarily lower your credit score. Limit the number of hard inquiries you make within a short period. Imagine your credit score is like a fragile glass. Every time you apply for new credit, it's like giving your credit score a little tap. Too many taps, and your credit score might crack or even break. That's why it's important to limit the number of hard inquiries you make within a short period. Think of it as trying on clothes at a store. You wouldn't try on every single outfit in the store, right? You'd pick a few that you like and try those on. It's the same with credit applications. Don't go around applying for every credit card or loan you see. Only apply for the ones you really need and are likely to get approved for. If you're shopping for a new car or mortgage, lenders might allow multiple hard inquiries within a certain time frame, like 14 or 45 days, to count as just one inquiry. This is called rate shopping, and it can help reduce the impact on your credit score. Number 7. Choose the right mix of credit. Maintain a healthy mix of credit accounts, including both revolving credit, credit cards, and installment loans, personal loans, etc. Just like a balanced diet is essential for good health, a healthy mix of credit accounts is crucial for a strong credit score. Think of credit accounts like different types of food. Revolving credit, like credit cards, is like a buffet. You can take as much or as little as you need each month, but you're responsible for paying off the balance in full to avoid interest charges. Installment loans, like car loans or mortgages, are more like a fixed meal. You have a set payment amount each month until the loan is paid off. A healthy mix of credit means having a combination of both revolving and installment accounts. This shows lenders that you can handle different types of debt responsibly. It's like demonstrating that you can eat both a salad and a steak, proving you're a well-rounded individual. Here's a simple analogy. Revolving credit cards, is like a garden hose, flexible and adaptable to your changing needs. Installment loans, car loans, mortgages are like a water pipe, fixed and structured, providing a steady flow over time. A healthy credit mix is like having both a garden hose and a water pipe in your home. You have the flexibility of the hose for everyday use and the reliability of the pipe for long-term needs. So aim for a balanced credit mix, just like you would aim for a balanced diet. It's a recipe for financial success. Number 8. Keep older accounts open. Length of credit history is a significant factor in your credit score. Keep older credit accounts open, even if you don't use them frequently. Imagine you're a teacher grading a student's essay. The longer the essay, the more information you have to assess the student's writing skills. Similarly, the longer your credit history, the more information lenders have to evaluate your creditworthiness. When you close an old credit account, you're essentially cutting off a piece of your credit history. This can make it harder for lenders to get a complete picture of your borrowing habits and make an informed decision about your creditworthiness. As a result, wealthy business owners often keep older credit accounts open, even if they don't use them frequently. This helps them maintain a long credit history, which is a positive factor for their credit score. Of course, it's important to manage your older credit accounts responsibly. Make sure to pay off any outstanding balances and keep your credit utilization ratio low. If you do that, keeping older credit accounts open can be a smart financial decision. Number 9. Avoid closing old accounts abruptly. Closing old credit accounts can reduce your available credit and shorten your credit history. Consider keeping old accounts open with a zero balance. Imagine your credit score as a measure of your financial trustworthiness. It's like a report card that lenders use to assess your ability to repay loans. One of the factors that affects your credit score is the length of your credit history. The longer you've had credit accounts open, the more reliable your credit history appears to lenders. Closing an old credit account can shorten your credit history, making you appear less creditworthy to lenders. Additionally, closing an account can reduce your overall available credit, which can increase your credit utilization ratio. Your credit utilization ratio is the percentage of your available credit that you're using. A high credit utilization ratio can also negatively impact your credit score. Instead of closing old credit accounts, consider keeping them open with a zero balance. This way, you maintain the positive impact of a long credit history and avoid negatively affecting your credit utilization ratio. Just make sure to keep an eye on these accounts to prevent fraudulent activity. Number 10. Become an authorized user on a trusted account. Ask a family member or friend with an excellent credit history to add you as an authorized user on their account. Now, let's say your parents have a long history of making payments on time and keeping their debts low. They've got a great credit score, like an A+ student. If you ask them to add you as an authorized user on their credit card account, it's like piggybacking on their good grades. Their positive credit history will reflect on yours, helping you build your own credit score. But remember, with great power comes great responsibility. Being an authorized user means you'll be able to use the card to make purchases, and your spending will affect the primary cardholder's credit score as well. So, only ask someone you trust to add you as an authorized user, and make sure you use the card responsibly. Number 11. Pay down existing debt. Reducing your overall debt can improve your credit utilization ratio and credit score. Imagine you have a credit card with a limit of $1,000. This means that you can borrow up to $1,000 from the credit card company. If you use $500 of your credit, then your credit utilization ratio is 50%. This means that you are using half of your available credit. Credit utilization ratio is one of the factors that affects your credit score. A high credit utilization ratio can negatively impact your credit score. This is because lenders see people who use a lot of their available credit. By paying down your debt, you can lower your credit utilization ratio and improve your credit score. For example, if you pay down your $500 balance to $250, then your credit utilization ratio will be 25%. This is a much better ratio, and it will help to improve your credit score. Number 12. Consider secured credit cards if you have limited credit history. Consider using a secured credit card, which requires a security deposit. Sure, I can explain that in a friendly way. Imagine you want to rent an apartment, but you have no rental history. The landlord may be hesitant to rent to you because they don't know if you'll be a reliable tenant. A secured credit card is like a security deposit for your credit worthiness. You give the credit card company a deposit, and they use that deposit as collateral in case you don't pay your bills. This helps the credit card company feel more confident in lending you money, and it can help you build your credit history. Number 13. Avoid co-signing for others. Co-signing for loans can make you responsible for the debt if the borrower defaults. Imagine you're helping a friend buy a new car. They're excited about the shiny red convertible, but they don't have the best credit score. The car dealer asks you to co-sign on the loan, which means you're basically promising to pay off the debt if your friend can't. While you might be tempted to help your friend out, it's important to understand the risks involved. Co-signing for a loan can put your own finances in serious jeopardy. Here's why. 1. You're on the hook for the entire loan. If your friend misses payments or defaults on the loan, you're legally responsible for the entire balance. This means you'll have to start making payments yourself, even if you never got to enjoy the car. 2. It can hurt your credit score. Even if your friend makes all their payments on time, co-signing for a loan can still impact your credit score. This is because it shows lenders that you're willing to take on additional debt, which can make them see you as a riskier borrower. 3. It can damage relationships. Co-signing for a loan can strain relationships with friends and family. If something goes wrong, it can lead to resentment, arguments, and even broken relationships. Instead of co-signing for a loan, consider offering other types of support, such as helping your friends save up for a down payment or providing financial advice. Remember, it's your hard-earned money, and you should protect it. Number 14. Use credit monitoring services. Enroll in credit monitoring services to receive alerts about changes to your credit report. Imagine you have a treasure chest filled with gold coins, representing your good credit score. Credit monitoring services are like having a guard watching over your treasure chest, alerting you if anyone tries to steal your coins, in this case, your credit score. These services keep a close eye on your credit reports, which are like detailed records of your financial history. They send you notifications whenever there are any changes to your credit report, such as new accounts being opened, credit card balances increasing, or negative information like late payments being reported. Just like a guard's alerts help you protect your treasure chest, credit monitoring alerts help you spot potential problems with your credit score early on. This allows you to take quick action to address any issues and prevent them from damaging your credit score. Number 15. Understand credit scoring models. Familiarize yourself with the different credit scoring models and how they evaluate credit worthiness. Imagine you're a lender and you're trying to decide whether to give someone a loan. You want to make sure that the person is likely to repay the loan, so you need to assess their credit worthiness. This is where credit scoring models come in. Credit scoring models are like a report card for your credit history. They analyze a variety of factors about your past financial behavior and assign you a numerical score, typically between 300 and 850. The higher your score, the more creditworthy you are considered to be. Lenders use credit scoring models to make decisions about who to lend to and what interest rates to offer. A high credit score can get you approved for loans with lower interest rates, which can save you a lot of money over the life of the loan. There are several different credit scoring models, but the two most popular ones are FICO and VantageScore. FICO is the oldest and most widely used credit scoring model, while VantageScore is a newer model that is gaining popularity. Number 16. Seek professional guidance. If you have concerns about your credit score, consult a credit counselor or financial advisor for personalized advice. If you're feeling overwhelmed by your credit score or you're not sure how to improve it, don't hesitate to reach out for help. Credit counselors and financial advisors are experts who can provide you with personalized advice and support. They can help you create a plan to manage your debt, improve your credit utilization ratio, and dispute any errors on your credit report. With their guidance, you can get your credit score back on track and achieve your financial goals. Number 17. Maintain a business credit history. Establish and maintain a strong business credit history for your company separately from your personal credit. Why you need a business credit history? Just like you have a personal credit history that tracks your borrowing and repayment behavior, your business also has a credit history. Your business credit history is a record of how your company has borrowed and repaid debt. It is used by lenders to assess the creditworthiness of your business when you apply for loans, credit cards, or other forms of financing. Why it's important to keep your business credit history separate from your personal credit history. Your business credit history should be kept separate from your personal credit history. This is because your business and personal finances are separate entities. If you have a strong personal credit history, but your business credit history is weak, lenders may be hesitant to approve you for business loans. Conversely, if your personal credit history is weak, but your business credit history is strong, you may still be able to qualify for business financing. Number 19. Pay business taxes on time. Pay your business taxes on time to maintain a good standing with the IRS and credit bureaus. Just like your town needs taxes to run smoothly, your business also needs to pay taxes to the government. These taxes help fund important things like roads, bridges, schools, and hospitals. They also help pay for social programs like Social Security and Medicare. When you pay your business taxes on time, you're not just doing your civic duty, you're also helping to keep your business in good standing with the IRS and credit bureaus. This means that you'll be more likely to get approved for loans and credit cards with favorable interest rate. If you don't pay your business taxes on time, you could face penalties and interest charges. You could also damage your credit score, which could make it difficult to borrow money in the future. Number 20. Establish business relationships with lenders. Build relationships with lenders and banks to demonstrate your creditworthiness and access better financing options. Just like any other relationship, building trust and rapport with your lenders is crucial for long-term success. By nurturing connections with banks and other financial institutions, you demonstrate your reliability and financial responsibility, which can lead to favorable financing terms and better access to capital. Remember, building a strong credit score is not an overnight endeavor. It requires consistent effort and financial discipline. By adhering to these sound principles, wealthy business owners can cultivate a credit standing that serves as a testament to their financial acumen, paving the way for continued success in the ever-evolving business landscape. Thank you for watching, like and subscribe.